Good morning. It's Tuesday, May 13th. Zach Howard. Here's your 3-minute global morning market update. What am I looking at to start today? What's on my mind? Global fixed income duration risk continues to build with bond yields. When that yield rises, especially on these long duration bonds, 20, 30, 40-year bonds, in some instances, the price of that bond falls. It's more receptive to rising interest rates. What we're looking at here is a Japanese government bond, a 30-year Japanese toilet paper. The Japanese government bond market is owned 52% approximately by the Bank of Japan. The Bank of Japan has been enacting what's called YCC, yield curve control, in the Japanese government bond market since about 2016. They've basically been an artificial bidder for that government debt. Canada had started that during COVID, other countries as well. The US arguably did it during COVID, but where do they go from here with all this debt that needs to get refinanced in the next 18 months? $6 to $8 trillion needs to get rolled over. And now with these rising interest rates on these long-term bonds, the servicing cost on that interest is an expense for the government, an added government expense. But what you need to think about in terms of this playing out in other markets is these government bonds, whether they're Japanese government bonds. This is the picture of the Japanese 30-year auction last night, went out at roughly 2.82%, but it's the rate of change in markets that matters. 2.94% was the yield on the 30-year bond auction, 600 billion won, which works out about 4 billion US dollars. Not a lot, but the rate of change the previous month in April was 2.4, the previous month in February 2.2. So that yield continues to rise, and at that Bank of Japan steps away from these auctions, the yield is going to continue to explode higher, which is going to bring down the price, bring down the value of these bonds. So these bonds are put up as collateral for pension funds, for insurance companies that are then using that liquidity through margin to purchase U.S. assets, the Mag 7, the NVIDIA stocks, what have you. The U.S. government bond, here's the chart of that. Same similar pattern, continuing to see a rising yield building up towards that magic number, 5%, which is going to get the headlines. But is this setting up for a potential that the U.S. starts looking at some type of YCC program in its government bond market with this added refinancing risk that continues to build? That's something to keep an eye on. Back over to the US equity markets. Look at this chart here on volatility. The VIX just completely falling out of bed now from that peak of 50 a couple of weeks ago, all the way down to 17, 18 here, bidding the risk assets again at these levels here today. So S&P 500, those Mag 7 stocks still continue to get bid as long as the VIX can stay down to these levels. That's what I got for you today. We'll see you tomorrow. Have a great day.